Now let's talk about single payment loans. There may be a collateral required, like a lien against some property that you own or some sort of mortgage or other contract. You need to know something about the maturity on the loan. When is the full amount due? And what are the repayment particulars? So is there a penalty? We mentioned this a little bit earlier when we talked about shopping for loans. Is there a penalty for prepayment? Can you roll that loan over into a new loan? So for example, if it's a single payment loan like we're talking about here with a big balloon payment, at the end of a certain time frame, could you just roll that over into a regular installment loan? So let's talk about the finance charges and the APR, or the annual percentage rate, related to this loan. If we're using the simple interest method for calculating finance charges, then the finance charge is calculated on the outstanding balance. With the discount method, the interest is subtracted from the loan amount and then the remainder goes to the borrower. So the finance charges are paid in advance, and then therefore the APR will be higher than the stated interest rate, because remember, the APR is what you're actually paying. So here's our formula. The finance charge that you calculate using this simple interest method is calculated by taking the principal times the interest rate times the term of the loan. So here's an example. If we have a $1,000 loan for 2 years at 8%, then what is our finance charge? So think about that for a second. The principal is $1,000, the stated interest rate is 8%, and the term of the loan is 2 years. So it's just going to be 1,000 times 8% times 2 years. So our finance charge is $160 on that $1,000 loan. So that means on a single payment loan, the amount that you'd have to pay back in that one payment would be $1,000 plus the $160, or $1,160. So that APR, or annual percentage rate, is the average annual finance charge divided by the average loan balance outstanding. So if we take that 160 that we just calculated, divide it by 2, and divide it by 1,000, we get 8%. So we're dividing it by 2 because this is a 2-year loan and we want an annual interest rate. So our average annual finance charge is the total finance charge divided by the number of years of the loan. And then we divide it by the principal and we get the 8%. So now if we use the discount method, here we have those exact same numbers. And so we calculate using the discount method the same as for the simple interest method, but we're subtracting the finance charges from the loan amount. So now what this means is that instead of you borrowing or getting $1,000, the full $1,000 when you borrow that principal, they're just going to go ahead and take that interest out and only give you $840. So it's a $1,000 loan, but you're only getting $840 as opposed to a $1,000 loan where you get $1,000 and you pay $160 on top of it. So in this case, we're going to calculate APR using that same formula, but now when we take the average annual finance charge, that's going to still be 160 divided by 2, but the average loan balance outstanding is not 1,000 anymore because we didn't get 1,000. We only got 840. So that means that the APR actually is higher than the stated rate.